Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, welcome back to another episode of the Finance Garage. As always, Jonathan Wu here, Senior Financial Advisor and Principal at the SWU Group. And today we're talking about one of my favorite tax strategies that, surprisingly, most Australians have never heard of. It's called catch-up concessional contributions. Now I know before you switch off because it sounds like something only accountants could get excited about, and financial advisors, stay with me for a second. Because this one strategy has the potential to save some Australians thousands, even tens of thousands of dollars in tax. The interesting part, though, is that it isn't a new strategy and it's been sitting there quietly in the legislation for years. The problem, though, is that hardly anyone knows it exists and even fewer people actually use it. Now, what's made this strategy even more relevant is the recent federal budget. And while there were a number of tax changes announced, one of the broader themes coming out of the budget is that superannuation has arguably become even more attractive than investing outside of super. So today I want to explain not only how catch-up concessional contributions work, but also why the changing tax landscape means now is a great time to revisit your super strategy. Now let's start with the bigger picture, and whether you agreed with every budget measure or not, whether you're on the left or on the right, there's one clear trend. The government has continued to make investing outside of super a little less attractive, while superannuation continues to enjoy significant tax concessions. Remember that, if we look at capital gains, for example, Australians have really relied on the 50% capital gains tax discount when they've held an investment for longer 12 months. However, following the recent budget, many newly acquired assets will no longer receive that same generous treatment, and for many taxpayers, the effective minimum tax rate on capital gains has increased to 30%. So even, the historical strategy of waiting till you're retired and then you look to sell an investment property, for example, that's sort of gone out the window, especially for newly acquired assets. Now, if we compare that with superannuation, if your super fund sells an investment during the accumulation phase, so the time in which you're still putting money in, the capital gains tax can be as low as 10%, provided the investment has been held for more than 12 months. And then once you're retired and drawing an account-based pension, assuming you're within the transfer balance cap rules, those same capital gains can potentially be taxed at zero. Think about that difference. Outside of super, around 30%, or effectively at least 30%. Inside of super while you're working is 10%, and inside super once you're retired is potentially zero. That's an enormous tax advantage, or what we call tax arbitrage. Now, I'm not saying that every investment should automatically go into super. Super's got its own issues. And when I see new clients, I talk about this concept of a tax spectrum. You have to consider personal versus superannuation being the two ends of that spectrum, and there are a number of other structures you can use in the middle. Personal name is always the best from a liquidity perspective, but has the highest potential tax rate. Superannuation has potentially the lowest tax rate, but the lowest potential level of liquidity. Because you generally can't access your money until you've met a condition of release, so that flexibility is sacrificed. But if you're already planning to contribute into super anyway, today's tax environment arguably makes those contributions even more valuable than they were only a few years ago. You're not only receiving an upfront tax deduction, you're also moving more of your wealth into one of Australia's most tax-effective investment structures. And that's exactly why today's topic is so important. Now, let's step back to the basics. For most Australians, every dollar you earn is taxed at your personal marginal tax rate. Some people pay 16%, others pay 30%, a lot of professionals pay 37%, and if you're a super high income earner earning over 200, for example, you could be paying as much as 47%, including the Medicare levy. Now, if we compare that with concessional contributions in a super, generally speaking, those contributions are taxed at just 15% when they enter your super fund. So straight away, you can see the attraction. The higher your personal tax rate, the larger the potential tax saving. So if we consider superannuation within that context, the next thing to tackle is, what is this contribution cap? The contribution cap is the limit that the government sets every financial year on how much you can contribute into super as a tax-deductible contribution. That is called a concessional contribution as opposed to a non-concessional contribution, which we'll cover off in another episode. But concessional contributions include your employer's super guarantee contributions, which is the 12% per year, anything you salary sacrifice into super, and any personal contributions that you later claim as a tax deduction, which is effectively the part that we're talking about today. These three components all count towards that same annual cap. So if the annual cap is 30K and your employer has already contributed 15K, you've effectively got another 15K available if you choose to contribute something extra personally in that financial year. So far, nothing too complicated, yeah? But here's the part that many Australians don't know. Imagine you didn't use all of that concessional contribution cap. So that extra 15K that you had, you didn't use. Most people assume they've lost that opportunity forever. The reality is it's not true. The government actually allows eligible Australians to carry forward their unused concessional contribution caps for up to 5 financial years. The simple way of thinking about it is, it's like annual leave. Imagine your employer allowed you to keep banking your unused leave instead of losing it every year. Over time, you'd build up a reserve. Then when it suited you, you could use a large amount all at once. That's effectively how catch-up concessional contributions work. You're building up unused contribution credits. And then one day, when the timing is right, you can use them. So why does this make sense? Let's be honest, life rarely goes according to plan, and during your 30s and 40s, you're often paying off a mortgage. You're raising your kids, you're paying for childcare, school fees, maybe even supporting your aging parents. So it's not exactly the top of your mind that you should contribute extra money into super because it isn't always a priority, and that's okay. And the government actually knows that. Instead of forcing you to use your contribution cap every year, eligible Australians can actually save those unused amounts for later.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
So now that you understand how it works through this sort of annual leave carry forward structure, the next question we need to tackle is, when does this strategy really shine? Now imagine your financial situation changes and perhaps one of the following has happened. You've sold an investment property, or you've sold your business, you've received an inheritance, you've received a large work bonus, or if you run your own business, you had an exceptionally profitable year. Suddenly, your taxable income is much higher than normal. This is where catch-up concessional contributions become incredibly valuable. Instead of simply paying tax on that additional income, you may be able to contribute some of it into super, claim a tax deduction, reduce your taxable income, and at the same time, increase your retirement savings. You're actually achieving 2 financial goals with exactly the same dollar. 2 birds, 1 stone. Let's put this into practice and let's use a real life example, and let's call her Sarah. Sarah receives a $60,000 work bonus this year, and over the previous 4 years, she had been concentrating on paying off her mortgage and hadn't made any additional super contributions. And as a result, she'd accumulated $35,000 of unused concessional contribution cap. And rather than simply paying tax on the entire bonus, Sarah decides to contribute an extra $35,000 into super, and she claims it as a tax deduction. Instead of paying tax at a personal marginal tax rate, that contribution is generally taxed inside super at only 15%. So depending on Sarah's circumstances, she could save many thousands of dollars in personal tax, because if her marginal tax rate is higher than 15%, let's say for example it's 30%, then by contributing that extra 35,000 to super, she saves 35,000 times 15%. And at the same time, she's actually boosted her retirement savings by $35,000, but you have to take away the 15% tax after that, instead of paying 30% tax if she took that in her own name. This is why advisors like us love this strategy. But there are a couple of caveats. Before you start rushing off and transferring money to super, which you should never do unless you've talked this through with your advisor, there is one very important eligibility rule. Your total super balance must have been less than $500,000 on the previous 30 June. Previous 30 June, not this 30 June. If your balance is above that threshold, then unfortunately you can't use the catch-up contribution rules. If you're below it, you may have several years of unused contribution caps sitting there waiting for you. Many Australians don't even know they exist. Now, remember, the other word of warning, I always remind my clients of this: don't leave these contribution strategies until the last week of June. I see it every year. People decide in the final week of June that they're going to make a contribution. The biggest problem is they transfer the money on the 28th or 29th or the 30th. Now, you assume the bank processes it the following day. You might have made the payment on BPay. BPay can take up to 3 days to settle. And unfortunately, these circumstances lead to the super fund only receiving the money in July. If the super fund only receives the money in July, that contribution counts in the next financial year, not this one, and you have no say in that. So it's too late. So every year I see people miss out because they leave until the last minute. So if you're considering this strategy, remember to plan ahead. The best thing that I've learned over the last 20 odd years of doing this is that the best tax planning isn't done in June. It's done in actually July for the year ahead, right? The clients who save the most tax generally aren't doing anything extraordinarily. They're just planning ahead. They know they're selling investment, they know they'll receive a bonus, they know they're retiring, and because they plan early, they've got the options. After the financial year is finished, well, your opportunities have already gone. So if any of these situations sound familiar, might be worth having a conversation with your advisor, because if you've sold a business, sold investment, received inheritance, had a particularly high income year, even if you've had a redundancy, or you received a significant work bonus, you should have a think about this, right? Because catch-up concessional contributions, if you've got less than $500,000 in super, based on last year's 30 June total, it could potentially be one of your most valuable tax strategies available to you. One of the biggest myths in financial planning or financial advice is that great strategies are always complicated. I can tell you they're not. They're usually quite simple rules, but Australians just don't read up on it. And catch-up concessional contributions are a perfect example, right? So if you are in this position and those questions were raised, you've answered yes to any of them, well, that's a powerful start already. So speak with your financial advisor, speak with your accountant. You can actually check your available unused contribution cap in the ATO portal within MyGov, and then take it from there. As always, if you've found this podcast useful, please follow, give me 5 stars. That really helps. Share it with your friends and family. And as always, remember to listen to the end of this episode for the disclaimer, as none of this is personal financial advice and just for entertainment purposes only. And with that, I hope everyone has a great week, and I'll see you in the next one.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.